Okay, greetings back, class. We're here in part B, and we were talking about record entries and combining the records together. And you already took part in part A, which is the more or less the lecture form. Right now we're going to be going and giving you some examples of how we make the entries and the reasonings behind that. Okay, so let's go ahead and start with the first one. We'll look at the first entry here. The first entry here says that $2,000 for a soil mixture we purchased it last year. Okay, and so we're going to determine what you're going to do with this exercise. You're going to determine entries, where the entries go as far as for records. So, okay, now we know we bought something, right? So, knowing that we bought something we purchased it last year, because we're talking about last year right now. I mean, so the clue here is last year. So we know it's going to be on the beginning inventory this year, right? Because it was bought last year. It was probably on the inventory, but now you're going to bring it forward. So you know it's going to be here the January 1st. And we're going to keep it, which means that we're not selling it, so we're going to have it at the end. So it's going to show up at the beginning and the ending of this current year. Okay. Keep in mind that it's a capital item, which means it was over $1,000. It was bought last year as an expense, and when you buy something like that, capital, it's an expense when you buy it, and then it's converted into inventory when you carry it over. Okay, at the end of the year, we still owned it, so basically it's going to appear on the closing inventory. We bought it as an expense. We still have it at the end of the year, so now it's going to be on the closing inventory. Okay, now because it was a closing inventory from the previous year, it must appear on the beginning for this current year, and that's how it goes from year to year. So you close it off with it, and you open up with it. Okay, now those items, if the items were sold or traded or stolen or damaged or salvaged, then if those things didn't happen, it will appear on your closing inventory. So let's take a look at the record lifeline down here at the bottom of the page. So we had an expense the previous fiscal year at $2,000. Okay, now we still have it, so it's now going to appear on the closing inventory because we're closing off. We have it. It's an asset that is a value. Okay, so now we're going to open up in the new current year here, new fiscal year, and now we're going to say January 1st. It's on our opening inventory, okay, our beginning inventory. And then we didn't sell it or anything. We kept it, so it's going to appear in the closing inventory as well, and the value will stay with it. And so that's how that particular item is done. So that's an example, one way in which you look at how you use inventory expense as far as buying something, and it goes into your capital and then it goes into your inventory. Let's look at another one. Let's look at this. 2,000. So same thing. So this next current year, with $2,000 soil mixture we purchased last year that we talked about, but we decided we sold it in May, okay, during the current year. And so because of that, now we know that it was on our beginning inventory when we started, but May is halfway through, or 5 months into it. And so now what we're going to do, that money when we sold it, well, it's going to go in an income record because it's money coming into the business. And now it's taking off of inventory, okay? So it won't be on our inventory anymore as of May, because we sold it, we got money, we put the money into income, and so it goes into the income record, and now it's off the books. Okay, so it's a capital item. It was bought last year, so it was an expense when it was bought last year, and we still had it last year, and so it would go on in inventory. We opened it up this year, and we had it on beginning inventory, but we sold it in May, which means now we have cash for it. We no longer have it on inventory, but we have cash for it, and so now we need to put that money into the income. And so basically, we receive the money, so the money comes into the business. So if you look at on the bottom of the page there, the record of life, well, it was an expense. We paid $2,000 for it last year. It was on our closing inventory. So now we look at it, and now it started off in our beginning inventory, in our beginning or opening inventory, but then we sold it. Well, we sold it in May, and so that means that it becomes income. And now it's no longer in our books as far as for inventory because we sold it, we got the cash for it, it's in income now. And now it's off our books for as far as it being a capital assess on that. Hold on. here a minute as I do some. Okay, I'm back. We had a little power problem, but we got it good to go now. Okay, so and ending then, as we showed you, that became income. So let's go to another one. Let's go to the third one. And so we have $1,000. Say we have a soil potter. We bought it in November of the current fiscal year. So we're in the current year. We bought it for $1,000. It's over $100, right? Okay, so we know it's an expense. We paid for it. It becomes an expense item. And because we didn't sell it, we bought it and we didn't sell it. We held on to it till the end of the year. Now it goes into closed inventory at the end of the year. Now, with that in mind, it's a capital item, which you said it was over $100. Okay, it was bought as an expense last year, and we had it towards the end. We had it in the ending inventory of last year, so it went into the ending inventory, and then it opened up into the current year, and it will open up next year into the current. Okay, so because it was bought in November, the current year, the potter will appear on the closing inventory of this year. And as it closes off this year, remember next year, when we go into next year, it will then move into the inventory of the new year, which is beginning. So let's look at, we're in a new or current year. We bought this item for $1,000. Okay, it's an expense. Okay, paid money for it. And then it showed up, and we still own it at the end in January 30 or December 31st, and so now we have it at the end. So that's so that shows up in our closing inventory. Okay, let's try another one. Okay, so let's look at this next one. So say now we sold 4,000 poinsettias for $5 per unit in November of the current fiscal year. Keep in mind now we're talking about a season crop here, which means they're only good for November and December, and really you don't really want to carry. Why would you carry on poinsettias after December? No one would buy them, right? So it's pretty much a limit on that. So we know we don't want to have inventory of that, right? We'll give them away before we have inventory. So, but anyway, the point is we sold 4,000 poinsettias. So we raised them for income, right? So we brought that money in, and we sold it. We got cash back to the business. And if you look at it, we know we didn't have closing inventory off of it. We didn't have beginning inventory. I'm sure we had expenses, but we're not talking expenses right now. We're just showing you what happens when you mark down income. And so income for the project was $20,000. Okay, and then you're done. And there's no closing or anything because you raised that particular item. It went down as an income, and that's it. Pretty sweet deal on that one. Okay, let's try 5. So let's say we sold 4,000 plants for $4 per unit in October, and in the current fiscal year, on the last day of the year, we still had 1,000 plants left over. Well, now this is not seasonal. It looks like these plants are plants that we're going to be using for next year too, because we're going to keep them alive, right? Okay, with that information, we know we raised them. We have them for income. We had 4,000 plants for $4 per, and we still had $1,000 left over when December 31st came. So 1,000 plants will go into our closing inventory, and we would rate them at $4 per plant. That would go into the closing inventory. These items are produced for sale for income. Okay, it's cash money coming into the business for income. Plants remaining on site but cannot be considered income. No money coming in with them has to go into the closing inventory. Okay, and it's listed as the value that it is. So here we go. That as you look at that, it goes into closing inventory because we had it left over. It comes back in the beginning or starting inventory, and then it's ready to do income for the next year. Okay, so that's some examples. Now let's you can go to part C, where there will be some more practice time. Okay, thanks.